Before I introduce the speaker, please allow me to mention a few housekeeping rules for this webinar. Number one, for ASM members, please be reminded to check in the attendance using the QR code or log on to the Google website. The link can be found on the chat box on your right. This is for CPD recording purposes. Number two, if you have any question, please post your question using Slido. And also, you can join in the Slido. You go to your browser, type in slido.com and put in the access code 92561. We will try to address your question during the Q&A session after the presentation. Today, Zainal will speak on the challenges in financial reporting under IFRS 17 for Takaful operators, and he will provide commentary on the MESP proposal on the application of IFRS 17 on Takaful. Zainal is a senior partner at Actuarial Partners Consulting. He has been a consulting actuary with the company since 1982. His years of consulting experience spans the full spectrum of actuarial services, including life and general insurance consulting, family and general Takaful consulting, retirement benefit consulting, and investment consulting. He is a pioneer in Takaful, having been involved in Takaful industry since its establishment in Malaysia in 1986. He has also been involved in the development of Takaful overseas, including in Saudi Arabia, Bahrain, UK, Tanzania, Sri Lanka, Indonesia, and Brunei. In recognition of his involvement in the development of Takaful globally, he was presented with the Lifetime Achievement Award at the 2017 International Takaful Summit in London. He has been a member of the IFRS 17 Working Group at the Malaysia Accounting Standard Board since the working group's inception. The working group has been providing input to the International Accounting Standard Board in London on the earlier draft of the standard. He is currently on the MESP TRG looking at how to apply IFRS 17 to Takaful. He is a fellow of Institute of Actuaries in the UK and also the associate of the Society of Actuaries in the USA. He is also past president of the ASM. Okay, that's all of the introduction of Encik Zainal. So, Encik Zainal, you can start the presentation. We can't hear you, Encik Zainal. You need to unmute.
Yep. Okay.
Okay.
All right. So, good morning, everybody. Thank you for attending this webinar. I'm going to go through perhaps up to this point of the series on Takaful, a more involved kind of look into the issue of reporting financially for IFRS 17 for Takaful. I'm assuming here that the participants does have some experience in IFRS 17 or have actually spent some time looking through the standard itself because actually IFRS 17 is quite principles based, and in order for you to actually understand the principles underlying IFRS 17, you need to actually read the standard a few times, which I've done, but I'm still not very comfortable about all the sections within the standard. So that's how complicated it is. So what I'm going to do this morning is actually to, let me share my screen. Okay. Okay, so I'm going to go through some of the issues that we have faced in terms of trying to make this standard applicable to Takaful. So the burning question that everybody had at the end of the previous presentation by Hassan was that does IFRS 17 applies to Takaful? So I think let me put that straight at the beginning and to say that yes, it does. It does apply to Takaful. The question is, how would it apply to Takaful? And that's what we're trying to that's why we're trying to actually determine this morning. So when Shu presented the first topic in this series, she talked about the various Takaful models and understanding each Takaful model and what are the profit drivers for each model. And then it was the turn of Aiza, and Aiza sort of mentioned or presented in terms of the role of regulation in the success story of Takaful in Malaysia. The importance of regulation in Takaful cannot be underestimated because of the fact that, unlike insurance, Takaful is a combination of a mutual and a proprietary arrangement. And there is a need to ensure that the participants to Takaful are actually protected when they buy that Takaful contract. Then Hassan came in the third presentation. We were deep dive into the Takaful model, and he addressed two very important aspects of Takaful, which is the card. What exactly is the card? And also about surplus sharing. We see in his presentation how a policy can be profitable at the contract level, but not at the risk pool level. We see how by setting the level of the Wakalah fee, the profit sharing percentage between the participant and the operator changes. So this is very, very important. And as you see, as we go through today's presentation, you can see that that is key in terms of the difficulty of applying IFRS 17 at the Takaful entity level. Today, I'm going to talk about Takaful and the challenges in presentation. And I'll try to go through this as slowly as possible because it is a complicated subject. And I'm sure that within the group of participants in this webinar, there are various levels of understanding of IFRS 17. So let's recap. What are the key distinct features between insurance and Takaful? Well, first of all, there's a separation of funds. This separation of funds is actually very different from the separation of funds that you see in a life insurance participating fund. In a life insurance participating fund, you do have the par fund separated from the non-par fund, but effectively that par fund still belongs to the shareholders. The reason why the par fund is separated is purely from the perspective of trying to determine how to apply the 90-10 or 20-80 profit determination. You can go to countries such as Thailand, for example, where they have participating policies, but they do not actually segregate the participating policies from the whole fund, i.e., it is within, if you like, the same balance sheet, and there's no physical separation between the assets of the par fund and the non-par fund. The second issue is this issue about trying to determine who owns which part of what profit. So in insurance, life insurance, general insurance, especially in life insurance, now you've got more component of profits that you have to manage. For example, the investment profit, the underwriting profit, and the expense profit. So by determining the level of the Wakalah fee, you can actually determine what percentage of the underwriting profit goes to the operator and what percentage goes to the participants. And at the total contract level, i.e., you just consider one contract, you can actually determine, what's the profit sharing for that one whole contract, just considering this one contract, what the profit that contract is expected to actually deliver over the duration of the policy, how that profit is actually split, between the participants and operator. If you remember Hassan's example. Now, as compared to insurance, Takaful has got many more regulation that governs its operation. And as I said just now, this comes about because of the importance of actually managing the participants' rights, as it were, within the Takaful business. What we have in Takaful is a conundrum. You have the operator, if you like, is a driver. If you say like the company is, let's say it's a car, the operator is the driver of the car, and the participants basically are the passengers in the car. So the operator basically drives the car in a direction that it wants, taking the participants with it. How do we then actually ensure that the participants' expectations are actually protected? So that's the challenge of Takaful, and that's why we have so much regulations in Malaysia. And TOF is one set of regulation which Bank Negara basically introduced to protect the participants. So what's the agenda for today? We're going to look at the purpose of Takaful, where the industry is now in terms of how Takaful should be accounted under IFRS 17. Then we're going to talk about the difference between IFRS 4 and IFRS 17. I'm not going to go through all the differences, but those differences which I think are important that should be highlighted for the purpose of this presentation. Then we're going to look at a typical family Takaful operating model in Malaysia. And then we're going to dive through the income statements under IFRS 4 and IFRS 17 for a simple family Takaful operation. Finally, we're going to talk about what are the questions outstanding and how the industry in Malaysia perhaps should be planning in terms of moving forward. So what's the purpose of IFRS 17? So IFRS 17 is about insurance contract accounting. It applies to any entity which issues insurance contract and does IFRS accounting. You need to actually understand that not only insurance company can actually issue insurance type contracts. Insurance contract by definition in Malaysia can only be issued by insurance companies. This might not be the case in other countries, but sometimes institutions such as banks have got insurance-like contracts which could be accounted for under IFRS 17. Right? So you need to understand that IFRS 17 is about insurance contract accounting. Right? So in a company, an entity, if you like, you have other IFRSs, but in respect of the insurance contract within that company, it should be accounted for under IFRS 17. So IFRS 17 does not only apply to insurance companies. What's the purpose of IFRS 17? Well, effectively is to ensure consistent accounting. We've addressed this question before. Is to ensure that people have a better understanding of the profit drivers of insurance companies, what to expect in the future in terms of the profit from the insurance operation. The second point here is to build on the first point, is actually to improve the understanding of the insurance financial statement. The chairman of the working group at ISB for IFRS 17 made a very, what I would say, a very interesting comment. He recognized that the current accounting standards for insurance is not adequate. When you use the word very inadequate, is not adequate. And he points to one important fact. He mentioned that in many circumstances, in addition to looking at the financial statement under IFRS, insurers also produce reports for their operation under embedded value calculations, the traditional embedded value calculation, the market consistent embedded value calculation. Because you cannot apply the same kind of yardstick to insurance as you might apply, for example, for a widget company, right? The price earning ratio of an insurance company varies from company to company, and is not necessarily an indication of difference in terms of the value of the operation. So here's where IFRS 17 comes in. what IFRS 17 is trying to do as well is perhaps to replace the way the figures in which now investors place in terms of assessing an insurance company. Instead of looking at their embedded value calculation, look at the accounts and look at the contractual service margin. That will give you an indication of the profitability of the block of business and how this is going to emerge in the future. So specifically IFRS 17 is to actually achieve transparency as to the way the entities can earn profit and how losses are accounted for. And it actually highlights the two services that insurance company provides: underwriting services and investing premiums for customers. So you see that in the IFRS 17 statements, the IFRS 17 accounts separates out the two different contributions to profit: profit from underwriting services and profit from investing premiums for customers. What's important is that IFRS 17 is not about changing the underlying economic phenomenon of the reporting entity. Yes, it does change the way in which the profits underlying an insurance contract would emerge over the duration of the policy, but in no way does it change the total quantum of the profit that the particular contract can be expected to actually provide. Okay, so this is very, very important, because later on when we talk about Takaful, whether in fact, whatever the basis you use for accounting at the Takaful entity level, does it change the economic phenomenon of the reporting entity? So where we are now in terms of Takaful IFRS 17. IFRS 17 was actually introduced 3 years ago, right? In May 2017. We're now already in July 2020. Over the period of time, there have been discussions in terms of how to apply IFRS 17 to Takaful. Only in this 2020 has this accelerated, right? So what I'm going to actually sort of present in the next couple of slides is look at what is the current agreement about how Takaful how IFRS 17 should apply to Takaful. Right? So we all agree that effectively, Takaful risk fund underwrites the insurance contract as an entity. Takaful, you consider the Takaful fund, if you like, as an entity, right? As one entity, basically, for which the participant subscribes to the participants fund. Here I'm talking specifically about participants risk fund. So this is where actually the sharing of risk happens, right? So we all agree that this risk fund actually underwrites the Takaful contracts. And we also agree that the PRF, the Participants Risk Fund, is a mutual insurer. Why is this important? Well, when you apply IFRS 17, you need to actually apply what we call the cohort requirement, right? I'll explain a bit more in terms of what that is. So you need to apply the cohort requirement on the contracts that the entity writes. Now, applying the cohort requirement is a lot of work, but the ISB was at pains to actually explain that applying the cohort requirement is one way to achieve the objective of IFRS 17. It is not basically the ends, it's the means to the ends, if you like, all right? So if you could actually achieve the same financial results without applying the cohort requirement, perhaps in terms of Takaful, applying IFRS 17 at the fund level, at the portfolio level, rather than at the group or contract level, if the results are the same, then there's no need to apply the cohort requirement. And that's a very big advantage if that is actually decided upon. And at this point of time, I think we are in agreement that as far as the PRF is concerned, you don't have to apply the cohorting requirement. The next one is that separate distribution to the PRF from the PRF to the participants is not a distinct investment component, right? Why is this important? Well, the accounts is also for the purpose of the participants. They look at the accounts of the Takaful operation to see how is it doing. And one of the things that they actually will look out for is that does the Takaful operator actually declare any surplus distribution to the participants. So if you don't have that item shown in the Takaful Risk Fund or Takaful Fund entity accounting, then there will be concerns that the participants would misinterpret, if you like, the Takaful accounts. So under IFRS 17, if it's an investment component, it should not be shown in the income statement. So by saying that it is not an investment component, then it's actually possible to actually show the surplus distribution of the participants in the IFRS 17 accounts. The next point that we are in agreement with is that at the participants' risk fund level, whatever surplus distribution that is paid to the operator can be treated as a performance fee. Because it is a performance fee, then it forms part of the fulfillment cash flow. Obviously, later on, I will actually explain why this is also important. The fifth item that we've agreed is that the columnar presentation of the financial statements is required. Right? Initially, the MSB had only recommended one column in terms of statement to be presented by the Takaful operator, and this will be supported by notes to the accounts that actually elaborate in terms of how Takaful actually works, if you like. All right. However, after subsequent discussions, they have actually accepted that the multi-column presentation, which is actually what is currently being done under IFRS 4, is actually still necessary under IFRS 17. And what's the reason for the change in line? Well, effectively, in Malaysia, we have got laws that actually manages or determines how Takaful is actually done. Okay, so we have, for example, the IFSA 2013, right? So Section 91 requires the establishment of a separate Takaful fund, separate from the shareholders fund. Then there's IFSA Section 92, which states that the licensed Takaful operator is effectively only a manager of the Takaful fund. So this is embodied in an act of parliament. So it is law, basically. It overrides whatever the might be in the contract, the Takaful contract. Because you compare the Takaful contracts of the different Takaful operator, there could be differences in the way in which the contract is structured. So someone just looking at the Takaful contract might not actually get this. The fact that it's a separate fund altogether, right? The fact that the Takaful operator is the manager of the Takaful fund, and this act actually overrides whatever it is in the Takaful contract itself. That's very important to actually appreciate. In addition to the Takaful Act, you also have the IFSA, the Islamic Financial Services Act. There's also the Takaful operating framework, because the IFSA applies not just to Islamic insurance company, Takaful operators. It also applies to banks and other Islamic institutions. So there is actually a supplemental Takaful operating framework, which are regulations, if you like, issued by Bank Negara, which reinforces the legal fact that the Takaful fund effectively belongs to the participants and not to the shareholders. So because of these points, then it is very much agreed that the Takaful fund can be a separate reporting entity with its own standalone financial statement applying IFRS 17. Remember at the beginning, I mentioned that IFRS 17 applies to insurance contracts. It not necessarily applies to the whole company. It does not say that IFRS 17 applies only to insurance companies. No. All right. So here we're saying is that the Takaful operator has got this entity, which is the risk fund, Takaful fund as it were, and IFRS 17 applies to this particular entity. So what has been decided? Well, because there's concerns in terms of cost and benefit, i.e. now there's more costs required in terms of implementing 3-column approach, like we've got now IFRS 4. MSB has actually recommended a 2-column approach. You only show the Takaful fund column and you show the Takaful entity column, right? So now we're going to look at IFRS 4, IFRS 17. I'm just going to highlight certain differences in IFRS 4, IFRS 17. Now, there are other differences as well, but we don't have the time to go through all the differences. But these are the main differences that you need to actually be aware of. First of all, under IFRS 4, the actuarial technical liabilities are calculated independently of IFRS. In Malaysia, it is based on Bank Negara risk-based capital requirements. In the country where you are in, it could be a simple Solvency I type determination of your insurance liabilities. For life insurance, for example, you could be using just simply a fixed 4% discount rate, mortality table issued by the regulator. Okay, but under IFRS 17, regardless of which country you are operating under, regardless of what is the regulatory requirement in terms of what you should calculate your regulatory liabilities or solvency liabilities, you have to apply IFRS 17 to your statements for reporting purposes. What's the difference? Well, IFRS 17 technical liabilities, there are actually guidance in terms of what method you should use for determining your accounting liabilities. Also, how you determine the assumptions that you use in determining your technical liabilities. And for Malaysia, that will not probably be the same as that's required under RBC. I say probably not the same because in Malaysia, we're moving to RBC 2, which is currently still under consideration. How RBC 2 will determine the liabilities, the insurance liabilities. The next point here is that there are actually differences in the way in which profits and losses under insurance contracts are actually determined under IFRS 4 and IFRS 17. What do I mean by this? Well, here I show on the left side IFRS 4 and the right side IFRS 17. And if you look, first of all, at the green column, this is actually the inflow, if you like, for this particular contract. And you can see that for the IFRS 4, I say expected future gross premiums. You look, gross premiums means what is the premium that the policy actually pays out, you need to pay under that contract. Under IFRS 17, you're saying that need not necessarily be the same. Because what we're looking at is that we're looking at the present value of the expected fulfillment cash inflow. And not everything in the gross premium constitute a fulfillment cash inflow under IFRS 17. So that's one difference. Now, if you look at the liability side, on the liability side, you can see here, all right, on the liability side, under IFRS 4, you have only the value of the guaranteed benefits and what we call the PRAD, provision for adverse deviation. The sum of the two, if you like, constitute the total insurance contract liability. So you have got the expected future gross premium, which is the so-called assets, because this is all determined at time t equal to 0, right? You not receive any premium yet. So you got the income and you got the outgo, expected outgo, as it were. And the difference between the two, between this and this, is a surplus. And this surplus is actually released at time t equal to 0. So you might have a contract for which the premium is payable over a period of 10 years. But under IFRS 4, the profits over that 10-year period is released at the point of time that the first premium is paid. Okay, that's under IFRS 4. Under IFRS 17, all right, so I mentioned just now in terms of fulfillment cash flow, the present value fulfillment cash inflow is where you have the assets at time t equal to 0. Under IFRS 17, the liability is actually inclusive of this contractual service margin. The fulfillment cash outflow can be different from the guaranteed benefits. It could include, for example, the value of the future surpluses to be distributed to policyholders. The risk adjustment could be different from the PRAD, because the PRAD in Malaysia is determined over the duration of the contract, whilst the risk adjustment under IFRS 17 is looking at that particular point of time, in terms of the portfolio, if you like, the underwriting entity, what kind of risk adjustment is effectively required for the Takaful entity to say, yes, I want to underwrite this policy. So this contractual service margin, the surplus that you see before under IFRS 4, is actually capitalized and kept, as a liability in the balance sheet. So what happened here is that was before at time t equals 0, we have all the surplus that can be distributed under IFRS 4. Under IFRS 17, sorry, no more the case. Now, effectively, you have the contractual service margin, and this is the liability, and this will be released over the duration of the contract. So, what are the differences? Well, this issue about grouping contracts, I briefly mentioned just now about cohorting, but before cohorting, there is a first level that you actually need to group the contracts. You got to group the contracts at policy inception to whether in fact it is a non-onerous contract, contracts where you expect to earn profits, you being the company. The onerous contracts, contract which for some reason or other, you are not expected to make any profits. In fact, it's an onerous contract. And there's a third group, which are others. Now, you cannot be quite sure whether it's onerous or non-onerous, so you group it on others. Under IFRS 4, there's no such sort of segregation. All policies actually commingle, right? So under IFRS 17, since we have got this differentiation between onerous and non-onerous contract, what you can do under IFRS 17 is you do something which all accounting standards principle is established, where all accounting standards apply the same principle, which is losses and are actually recognized immediately, and profits are actually earned over the duration in which a service is provided. So once you know that these contracts are onerous, you determine what's the level of onerosity, what's the loss if you like, and that's got to go through a profit and loss statement. All right. Whereas if it's profitable, then this needs to be recognized over the duration of the contract. And it's actually recognized through what we call a profit carrier, right? Then on top of this grouping, if you like, there's another level of grouping, which is basically the cohort, the annual cohort sort of requirement. Why the annual cohort requirement? Well, ISB sort of recognizes that in insurance, this is thing called a pricing cycle, whereby effectively the actuary prices the product based on its expectation, his or her expectation of what the future will be like. And on that basis, the premium stays over the duration of the contract. I mean, for general insurance, it's not a problem, it's just 1 year. But for life insurance, it could be for the whole of life. It could be 30, 40 years. So his pricing, if you like, for a very long duration of the contract, and it's based on his expectation of what the future will be at that point of time. So what ISB is saying is that you need to actually group contracts on an annual basis to capture the circumstances of pricing at that particular point of time. All right. So going forward, this annual cohort, you need to go back to the annual cohort and see whether that cohort is still profitable or otherwise. Such a requirement is not there under IFRS 4. Under IFRS 4, basically, again, it's all commingled. Then the third point here is that there's a requirement to lock the interest rate used to determine the profitability of the group of policies at the policy inception. So you have to actually maintain this information. What interest rate was used actually to determine the profitability of that group of policies at inception? So what is happening here is that in the IFRS 17, you need to look backwards. In fact, one of the biggest problem that we have in terms of applying IFRS 17 is having a big enough database to keep all this information for all the groups, for all the cohorts, of all the policies you have in your portfolio. So in IFRS 4, there's no need to look backwards. You only look forward, right? What's the future liability? What's basically the future income? What the fund you have? So basically that's all you need to do. But IFRS 17, there's more data you have to keep. Now, if we go to Takaful now IFRS 4, because of the fact that you don't have all this complication in terms of reporting, it's not a big issue in terms of applying IFRS 4, right? And satisfy everybody. When I say everybody here, all stakeholders, including your auditors. Okay. Now, for Takaful, because there is a narrower definition under IFRS 17 in terms of how profits and losses are counted, right? So it makes it more difficult to actually implement IFRS 17 at the Takaful entity level. it's not an issue at Takaful Fund level, because remember there's the columnar approach. So you need to apply the standard for each column, right? So the problem is actually the final column. Okay, so if the Takaful Fund column is accounted for differently from the Takaful entity column, right, then under what is being proposed by MASB, I will go into that later on, how should the Takaful entity column be accounted for? Should it be accounted for as a proprietary insurance entity? Are you looking at one contract? Forget the fact that you've got this wakala fee, all right? Just one contract, like any insurance contract, okay? Or what else should you do? Because of the fact that the Takaful Fund is accounted as a mutual. So what is a Takaful entity? This is a very important question that needs to be raised, that needs to be discussed. Okay? And the item B there is that how can the different profit share rights and obligation of the participants and the shareholders be accounted for at the TE level? Because as Hassan mentioned at this previous presentation, you have one contract, and under that contract, if you remember, it's $1,000, 1,000 ringgit as it were, and then you have like 200 ringgit for your expenses, you have 600 ringgit for the benefits, and you have 200 ringgit for your profits. But how you actually determine your wakala fee, whether it's actually 40% or whether in fact it is 60%, determines the sharing of the profits from that one contract. It could be 100% to the shareholders and 0 to the participants. This is assuming, of course, actual is equal to expected. Or it could be 50-50. All right, if effectively you cut the wakala fee at 20% and you leave the 200 plus the 200 surplus in the risk fund, right? So how you actually, for that one contract at the Takaful entity level, how do you ensure, how do you allow for the fact that certain contracts, surplus sharing is 100% to operators, certain contracts is 50%, 50% at the contract level. I'm not talking about the Takaful Fund level. How do you allow for that? So now we go to just example, because nothing helps to actually make things clearer by looking at example. But before we go to the example, let's look at the Takaful model, the operating model. This was shown during Shu's and Emma's presentation, the first presentation. And this is basically the wakala model with performance fee. This is what we've got in Malaysia. We call it the wakala model with performance fee. So what we have is the participants, it contributes the premium, all right, which is the contribution, we call it Takaful. And you have X%, which goes to the wakala fee, to the operator. Then you have Y%, that goes to the participant's investment account, because it's a life saving contract. So there is a component of the premium or the contribution, which is for savings. And then there's the remainder, if you like, goes to the participant's risk fund, right? I have a dotted line going from here to here because in some contracts, all the contribution first goes to the participant's investment account. And then from the participant's investment account, annually there's a drip, we call it a drip, of the risk premium to the participant's risk account, right? So we first go to the participant's risk account. Here, basically, you have got you call the risk tabaruk, called the donation, if you like, in the participant's risk account. This is a common account. And from there, at the end of the year, after you paid out all the benefits, you've got the surplus, we call it total surplus. And from this, you can pay a performance fee to the operator. In this case, we say 8%. And 1 month is 8% goes as a surplus to the participants. It's personal for him. And that goes back to the participants. All right. The participants' investment account, you invest the money on behalf of the participants, and then you come up with investment profit. And here as well, there could be a division in terms of how much of the investment profit goes to the participant and how much goes to the operator. Here I say B%, right? So from the operator's perspective, his business perspective, he's got to pay all these management expenses. He's got to allow for profit to shareholders. So what he has as the income is the wakala fee, the performance fee, and also a percentage of the performance, the investment profit. So you have the investment profit, the performance fee, plus the performance fee, plus the wakala fee. That's the total income of the operator. And from that, he pays the actual management expenses, and the residual is profit. So now we're going to compare the income statement of under IFRS 4 versus IFRS 17 for a simple family Takaful operation. So what I've used here is an example which the MSB has actually used in its example in its paper on the paper on columnar presentation of Takaful funds and Takaful entity financial statements. All right, so I've got a disclaimer here on the left side. All right, so this is not mine. This is from MSB. It's not exactly. I'll show you. I'll tell you later on where it's a bit different in terms of the ins and outs, if you like, for the company. So this is from the MSB, but the subsequent account entries that I'm going to show in subsequent slides, they are mine. So that's another disclaimer. Yeah, I'm not an accountant, but it's my interpretation of how it works, in accounting. All right, so first we go to IFRS 4. Right, and IFRS 4, you've got 3 columns in Malaysia. You've got a Takaful operator. You've got the Takaful fund. All right, and you've got the Takaful entity. So this Takaful fund is a combination of 2, the participant's investment account and the participant's risk fund. Right, some of the 2 if you like. So you have effectively a contribution of 1,000 ringgit, and that goes as a contribution. All right, so let's go through down the Takaful fund column first. There's no income with regards to Wakala performance fee, it's not applicable. By the way, let me just sort of describe a bit in terms of this policy. Effectively, this policy starts on the 1st of January. It's a 1-year policy, first of all. It's a life policy. It's a simple example. 1-year policy starts on 1st of January, terminates the 31st of December. All right. It is basically, if you go back to the previous slide just now, you see that, now let me go back to the previous slide. You did not notice. You can see here that effectively from the 1,000 ringgit, 50,000 ringgit goes to the Wakala fee. And then another 50,000 ringgit goes to the second reporting entity, which is the Family Takaful Fund, of which 40,000 goes to the participants' risk fund, the common pool, and 10,000 goes to the participants' investment account. So these are basically the 10,000 split into these 3 components, all right? And then from the participants' risk fund, you got the claims, if you like, the death or whatever benefits that you pay during the year, the Takaful benefits, let me call it Takaful benefits, the claims. And then you've got, effectively the difference is 30,000, of which 15,000 is distributed to participants and 15,000 is distributed as performance fees to the shareholders. So this goes to the 50-50 maximum profit distribution or profit allocation, if you like, between participants and operator that we've got in Malaysia, right? Now, in terms of participants' investment account, at the beginning of the year, you put 10,000. We're not assuming any investment income in this particular example, all right? Make things very simple. So just considering the underwriting profits, as it were, you got 10,000 in terms of contribution to the investment account. And then at the end of the year, you pay 10,000 out, right? Then you look at the shareholders fund, and effectively you've got the 50,000, which is the Wakala fee, all right? So 50,000 the Wakala fee, from 100,000, 50,000 goes to the operator, the shareholders fund. And then here's a hibah. Hibah is basically a gift. In Family Takaful, and sometimes the operator pays pays a gift, if you like, to the participants. For example, if the son or daughter, the participant scores distinctions in his exams, all right? So it's not actually an insurance kind of event, it's a sort of a, I won't call it gimmick, it's basically part of the profit, part of the product sort of features. Then if that happens, you pay a hibah, not from the risk fund, you pay it from the operator fund, if you like, from the Wakala fee that you collect. So the Wakala fee pays the hibah, which is gift, means hibah means gift. It pays the acquisition expenses, the commission it has to pay. It pays the maintenance expenses. You have to incur maintenance expenses here, all right, in addition to the commission that you pay. And if you look in terms of the difference between the Wakala fee and all these expenses, you come up with the fee that you get, the profit, if you like. Before that, you have the performance fee to the shareholders, which is basically coming from the results from the participants' risk fund of 15,000, and this is basically the amount that the shareholders will get for that year. Now, if you go to the company's column, you actually consolidate all this column, and it goes down to this final column here, for which you can see that from the Takaful company's perspective, the results are similar at the Takaful entity level and also at the shareholders fund level. So you see that clearly in IFRS 4. You've got the Takaful entity, you got the operator fund, and you get the Takaful fund. So you can see all the entries I mentioned just now. And the profit level at the Takaful fund, operator fund is 15,000, right? And the Takaful fund is also 15,000. But at the Takaful entity level, it is 30,000 because it's before the surplus attributable to participants, which is 50% of that amount, right? Here, just a note here, some companies basically, they show the wakala fee and the performance fee separately, but this need not be the case, all right? So in this particular example, I've combined it together. So the 65,000 is combination of the 50,000 wakala fee and the 15,000 performance fee that was actually distributed or accrued, if you like, in that particular year. So what do we see under IFRS 17? Under IFRS 17, you have this concept of expected and actual. This is income statement, by the way, right? So under the income statement, you've got what you call expected. What is it you expect? When the actuary prices the contract, he has certain expectations. He priced it into the contract. So you've got expected claims to be incurred. You've got, for the Takaful fund first, expected surplus to participants, all right? Expected performance fee that you have to pay, expected recovery. Sorry, you don't have, that's all basically, So that's the expected, if you like, the fulfillment cash flow for the Takaful and for the Takaful fund. At the Takaful entity level, you have those, you still have got the expected claims incurred, all right? You have the expected hibah, because that's going to be paid from Takaful entity. You have the expected surplus to participants. You don't have the expected performance fee because at the Takaful entity level, what is payable to operator is captured under the CSM. So you don't have that. It's not fulfillment cash flow at the Takaful entity level. But you still have got the expected maintenance expense, the recovery acquisition expenses, and what you have at the last column there is that contractual service margin, expected contractual service margin. How much of the total profit that you have as a liability in the balance sheet would be released in that year, right? So here, the expected revenue is 40,000 for the Takaful fund, and expected revenue at the Takaful entity level is 90,000, right? Based on this way of accounting. Now, if you look at the expected service expenses, you look at the Takaful actual service expenses, all right? I put it in red because it's an outgo. Here, I'm assuming the actual is equal to expected. So it's all red here. So you have 10,000 claims to be paid by Takaful fund. And then 10,000 surplus that is to be paid to the participants, 10,000 as a performance fee to the operator. So in total, expected service expense for that year is 40,000. At the Takaful entity level, you have the incurred claims, the hibah, the surplus, expenses, and then acquisition expenses. And in total, it's 75,000, right? So basically, that's what we got. We got expected revenue and you got expected service expense. So what's the difference between the two? Well, the difference between the two, between the revenue and the expense, is the contractual service margin, because all the rest basically cancels out. And effectively, this will come out, when you deduct the expense from the revenue in the income statement, you'll find that the profit for the year is actually the contractual service margin, which is being released in a particular year, of 15,000. One point that those people who are actually following this very carefully, you find that, effectively the figure 90,000 here is 10,000 lower than basically, what was actually the total contribution. That's because you got 10,000, which is an investment component. And under IFRS 17, investment component is not shown as a revenue. You remember the IFRS 4? Under IFRS 4, you have the full premium counted as revenue. Under IFRS 17, it's not treated as revenue. Same thing under Takaful fund, you don't have here, the investment component is the 10,000 that goes in the participant's investment account. That's not shown as a revenue because that is not actually insurance revenue. That is a savings component within the insurance Takaful contract. So you only got 40,000 here. And I'm not sure wakala fee as well as part of the revenue for Takaful fund because for reasons I'll mention a bit later on. So differences in the IFRS 17 sample accounts. All right, this is just by way of note, the MASB paper shows Wakala fee is part of Takaful revenue. I have not done that, but I think basically, IFRS 17.12 says that, effectively, a part, the component within that income that you actually recognize in that particular year, if that's not used in the fulfillment or fulfilling, if you like, in terms of the services that you provide, it should not form part of the income of that entity. So in this case, I'm saying the Wakala fee that's been done by the operator, so that should not be part of the Takaful fund revenue. The surplus with participants is treated as Takaful revenue and expense, right? In the MSB paper, it was not there because at that point of time, there was some disagreement in regards to what they should or should not. So after some discussion with ISB, effectively we all agreed that it should be treated as income. And the last 3.2, 3 and 4 are the small matters that I won't go into. So what's missing in the sample accounts? All right. Well, the sample accounts do not show any risk adjustment accounting. What is RA? Well, let me just quote under IFRS 17 what RA is, risk adjustment is. The risk adjustment is the compensation that an entity requires for bearing the uncertainty about the amount and timing of the cash flows that arises from the non-financial risks as the entity fulfills its insurance contract. So that's what risk adjustment is, right? So it does not show, the sample account does not show how the risk adjustment accounting applies, all right? At the Takaful fund level, nor at the Takaful entity level. Okay. You need to, I think it's quite obvious that at Takaful fund level, you need to have a risk adjustment, right? Because the Takaful fund is actually taking on that risk. Then the next point is that the sample accounts does not actually address how is B67 to B70. These are paragraphs, if you like, appendices, appendix B to IFRS 17 sort of document. How does B67 to B70 of IFRS 17 applies at the Takaful entity level, if at all, right? It does not show, the sample accounts do not show how the mutual aspect of Takaful are managed at the Takaful entity level. Is it ignored completely? Because is the idea here that at the Takaful entity level, it's one contract, and that one contract, is not a mutual contract, and therefore it should not be applied, right? It's just a plain vanilla insurance contract, and the risk adjustment, as it were, in that case, does not accrue to the participant's risk fund, but in fact accrues to the entity level, to the operator. That's a big, big, big question. Then another point as well is that at the Takaful entity level, is that the yearly cohort applies in all cases. ISB is very clear about that. In all cases, yearly cohort for insurance contract reporting, it applies at all level, all entity level. However, in a mutual entity, the results are the same whether you apply yearly cohort or you do the accounting at the portfolio level. So here at the Takaful entity level, you have to apply the yearly cohort. It is not a mutual, that's for sure. Takaful entity is not a mutual. So how do you actually do that? At the Takaful fund level, you don't apply at Takaful fund level, you don't apply the annual cohort level. You don't split by onerous contract, non-onerous contract. You apply B67 to B70. At the Takaful entity level, what do? Hassan's example, go back to Hassan's example, that 1,000 ringgit contract is not onerous because there's a surplus of 200. But when he takes, like say 50% as a wakala fee, what's left in the participant's risk fund is onerous because the claim is expected to be 600, but you're only leaving 500 to go to the participant's risk fund, right? So how do you define onerosity, if I can use that word? Next one is that how will part be accounted for at the Takaful entity level? All right. Now, this is a very important statement. The next statement I'm going to say. The IFRS standards are based on the expected model. What is the expected cash flows, right? And if you follow through this principle, then the part arising due to solvency issues, because one reason why effectively, you have a part, I think that is the first example in Hassan's example, is because of reserving strain, right? That part needs to be written off at the Takaful entity level. Even though it's just a valuation strain, you need to write it off. That's what the standard says, right? because it is an expected model. You expect to be a loss, and therefore you have to recognize the loss. And that card, under the IFRS 17, you apply at the TE level, will have to be written off. That is my interpretation, though. You need to ask the auditor whether that applies. Now, the question we've got here is now, that is the crux of the whole matter in terms of risk transfer sharing. By writing it off, you're actually doing risk transfer. So is this Sharia compliant? Your accounts, are they Sharia compliant if you write off the card at the Takaful entity level? So what are the questions outstanding, and where do we go moving forward? So the big question remains, what is the basis of accounting under IFRS 17 at Takaful entity level? All right. Now, if you look into this current IFRS 4 accounting for Takaful, the entity level accounting, the last column, if you remember from the previous slides, is a consolidation of the Takaful operator column and the Takaful funds column. So you got three columns. The Takaful entity column is a consolidation of the first two columns, right? So a valid question you might ask is that, why can't we do the same under IFRS 17? If we say, no, can't do that, If not, you can't do that, basically, So if not, what we're doing now under IFRS 4 correct? IFRS 4 is actually quite flexible. It's interim standards, and it does allow to do lots of stuff. So I wouldn't say it's not allowed to do what it's currently been doing, but I think a question can be asked: is it actually correct theoretically or not? Now, my interpretation of the MSB advice is that from a Takaful entity's perspective, the combined Takaful fund and operator activities constitute insurance services to be accounted under IFRS 17. So my question is that a conclusive assumption to make? Is it a slam dunk? No, that's it. No questions. The buck stops here. Do it. Okay. So, what's not yet resolved as well are all the issues I mentioned in the previous slide. So now we need to just deep down deeper and say, why is it MSB is insistent that at the Takaful entity level, the combined activities of the Takaful fund and Takaful operator constitute insurance services? Well, IFRS 17. First, let's go through the points. In terms of I've got 3 points I want to go through. Okay, the first one is that IFRS 17 is a much more comprehensive document as compared to IFRS 4. But IFRS 4 was the interim statement. Now, under IFRS 17, section paragraph 5, it says that an entity may choose to apply IFRS 15 instead of IFRS 17 for a particular contract, which includes an insurance element, right? However, this option is only applicable if the following conditions are met. First, the entity does not reflect an assessment of the risk associated with an individual customer. Example, you own a garage, right? And then you just fix somebody's car. They say, I'll give you a 6 months warranty. If the problem still persists, come back to me and I'll repair it for free, right? Does that constitute insurance services? Or is it IFRS 15, as it were? Because effectively, you don't actually reflect, that particular thing happening, when you charge him the repair bill. Then the B, in setting the price of the contract, setting the bill, if you like, to the customer. If he comes back, you don't give him cash. Here, cash, go to my next door neighbor here. He can repair his car as well. You can repair your car there. No. What you do is that, instead of giving him money because of the fact that the car breaks down, is that you say, I'll go and look again and see, I'll give the service for free, right? So it's making a service, not a cash payment to the customer. The third item here is that, the insurance risk transferred, in this case, there is an insurance type risk that the car might break down by the contract, arises primarily from the customer's use of the services rather than from uncertainty over the cost of the services. Because the cost could be a lot. It comes back a few times now, you have got to spend more time repairing the car. So the issue here is that, if you were to look at the standard, does a Takaful operator, what Takaful operator does does it actually satisfy this question or the standard? Does the wakalah fee reflect the risk associated with the individual customer? Yes, it's a percentage of the contribution, all right, but that doesn't mean that it reflects the risk associated with the individual customer. When setting, the price of the contract, the wakalah fee, you actually, do you allow for, what happens when it comes, in terms of services you provide? Does the operator pays amount of cash? Should something happen? No. It's basically the Takaful fund that pays actually the compensation, not the Takaful operator. And C, is the insurance risk, if any, transferred by the contract arises from the customer's use of services? Or is it i.e., i.e. the services means the underwriting, the management of the ongoing contract, as it were? Or does it rise from the uncertainty, or rather than from the uncertainty over the cost of the services? So there's a Takaful, the role, the wakalah, the role of operator, if you like, does it satisfy all these conditions? What does MSB say? So MSB says that, its view is that the Takaful does not satisfy all the above conditions, all right? And it gives one reason, it doesn't give all the reasons, it's one reason, all right? Because it says that the Takaful operator's compensation includes a significant level of profit share. I would disagree with that, right? You consider one contract, one premium, if you like. The wakalah fee is a percentage of that premium. But what is the surplus? The surplus is the difference between two big figures, premium and claims. And that will definitely be lower than the wakalah fee. You can see that in the statements of accounts of Takaful company. The latest one that I've seen is for Sun Life Takaful, right? It was a week or so ago, and it shows the wakalah fee and it shows the performance fee. The wakalah fee was 155 million. The performance fee was less, about 10 million or so, less than 10%. So you cannot argue that you expect that the compensation, i.e. the income that you get from the surplus share, profit share, is very big. Now, in the particular case of Sun Life Takaful, it's less than 10%. So what's significant? Sorry if there's any accountants in this presentation, in this webinar. All right, it's all for discussion purposes. Okay. Now, next one is item 3 here. IFRS 17 says, 17.B17 says, an insurance contract, a contract is an insurance contract only if it transfers significant insurance risk, right? The point of contention here is that, does the insurance risk reside? Where does insurance risk reside? Where does insurance reside? Does it reside in the Takaful risk fund, or does it reside at the Takaful entity level? So which party is the underwriter of the contract? Is it the entity and under whose legal name the contract is issued? So say Sun Life Takaful, say that's the legal name, all right? So because it's got that in the contract heading, so you are underwriting because your name is there, right? Or is it the entity which underwrites the risk? Which entity underwrites the risk? There are two entities here, operator and risk fund. It's the risk fund that underwrites the risk. So if it's the latter, i.e. the risk fund is then underwriting the risk, then Takaful entity is simply an underwriting agent. Those of us who are old enough would remember that in the early years in the 80s, you got institutions called underwriting agent for motor business. They just basically underwrite on behalf. They've got the power of the pen, if you like. You go to them, they just sign they will just sign the contract slip. I've got cover slip. I've got the actual name for it. And you're insured. So you effectively that is an underwriting agent. So if the Takaful entity is the one, if the Takaful fund is the one is underwriting the risk, then Takaful entity is simply underwriting agent. So what is an underwriting agent? It's an entity which has the legal right to issue a policy on behalf of in this case, the Takaful fund. So if you look in terms of Lloyd's of London, you've got names and you've got syndicates, right? And you've got as well correspondence, right? So the Takaful entity in this particular case would be the names, either person underwriting the risk, member agent, basically who can underwrite on behalf of the name, all right? Or the correspondent, if you will, or the Takaful fund. Yeah, sorry. Okay, well, Takaful fund is the name of the syndicate. Okay, So here I've got an example of a Takaful Lloyd's certificate. So it's a Lloyd's certificate. It doesn't say, you know, the syndicate name there. So it doesn't mean Lloyd's is underwriting, because effectively, you know, in the contract it says Lloyd's certificate. No, Lloyd's is not underwriting. The syndicate is the one that's underwriting on behalf of the name. So it says here as well, under correspondent is not an insurer. So in Malaysia, that we have the Takaful FSA that says that, you know, the Takaful entity is not the insurer. Right? So it's not something which is unique to Takaful. We have something similar in Lloyd's. So why is Takaful not risk transfer? All right. So the question here is that is the obligation to provide card proof of risk transfer? Right? Is it proof of risk transfer? Hassan sort of mentioned a couple of reasons, couple of circumstances, you know, where card can arise. So card can arise for many reasons. Right? Unexpected losses is one. Okay. But there are also other reasons why card arises. Now, we just consider that reason for the moment. So assuming that claims experience is the reason for card, then we need to go to the next step. All right, you have a card because claims experience was bad a particular year. Okay, you have one in 100-year event happening, and it so happens it happens in the first year, not the 100th year. Bad claims, bad luck. So go on to the next step now. Will this underwriting loss in that particular year be transferred to the Takaful entity? Does it ultimately go to the Takaful entity? If so, then the Takaful entity is, in substance, underwriting the insurance contract. Now, under IFRS standards, assets, liabilities are recognized based on the concept of probability, right? So, paragraph 4.40 of the IFRS conceptual framework for the financial statements. Now, this conceptual framework for financial statements is effectively a guidance from ISB in terms of how IFRS should actually be structured. So all accounting standards must follow the principles sort of set out in this conceptual framework document. The latest one is 2018. Here I'm referring to the one in 2010. 2018 is an update of 2010, so it's still applicable from this particular aspect perspective. So it refers to the use of probability when determining future economic benefits. And I have to read this because this is important. The concept of probability is used in the recognition criteria to refer to the degree of uncertainty that the future economic benefits associated with the item will flow to or from the entity. The concept is in keeping with the uncertainty that characterizes the environment in which the entity operates, right? Or entity operates in uncertain environment. Assessment of the degree of uncertainty attaching to the flow of future economic benefits are made on the basis of evidence available when the financial statements are prepared. What information you've got now, and you base basically your judgment based on that information. You're not required to have a crystal ball here. You know, just what is it based on your current expectation. For example, when it's probable that a receivable owed to entity will be paid, it is then justifiable in the absence of any evidence to the contrary to recognize the receivable as an asset. Right? For a large population of receivables, however, some degree of non-payment is normally considered probable. Hence, an expense representing the expected reduction in economic benefits is recognized. So I'll give an example. You have a company which is already insuring one life, all right? So for that one life, you have expectation in terms of the income, all right? And you don't expect the guy to die. It's one life. You know, the probability of death, you know, you have that mortality curve, probably he won't die that year. So it's okay for you to actually recognize as a profit or income, if you like, with the full premium, you know, for the duration of the contract. However, if you've got 10,000 lives, you can't say the same thing. You know, some people will die. All right. So that's why the last statement there, when you have a large population, then you have to allow for the fact that some people will die. All right. So here in my example just now, you got one risk fund. So one risk fund, one PRF, do you expect it to incur a part which will not be paid in the future? If the answer is yes, is risk transfer, go ahead, Takaful entity, you account for it like any other insurance company. But effectively, we say that, you know, probably not, you know, because effectively, I think we've got good actuaries here. You know, we have reasonable kind of products. They are not priced discriminately. Okay, so we don't expect it to happen. Maybe 10% might happen. So 90%, it wouldn't happen. So effectively, there's no risk transfer. Simple as that, right? So the question I pose now, is it practical to implement IFRS 17 at the Takaful entity level and yet preserve the need not to compromise on Sharia compliance? Okay, but this is very important, right? So under IFRS 4, there's no question being raised by Sharia about accounting at the Takaful entity level. However, it is in no small part to the flexibility afforded by IFRS 4 as to how the accounts have to be prepared. So currently, the TE account column under IFRS 4, and this is the fun part. No? Currently, the TE column, the Takaful entity column, the company column under IFRS 4 can be interpreted to represent either one, a consolidation of the accounts of the Takaful operator, being the manager of the business, the parent, if you like, because the consolidation, you consolidate, you apply IFRS 10, I think, you consolidate, and therefore you have a parent, you have a subsidiary. And the Takaful fund, being the mutual insurer, is a subsidiary. So that's one way in which you can look at it. However, you can look at it in a different way. You can look at it that the Takaful entity is actually just an insurance company. Surprise? Well, let me show you. Right. But before that, importantly as well, the current accounting under IFRS 4, it preserves the economic phenomenon applying to all stakeholders. I mean, it does not show a different total profit. It shows the same profit that you expect under the contract. So remember, under Takaful, there are laws in terms of how profits can be distributed. So let me show you this. On the right side, let's go to the right side first. On the right side, you have the company, if you like. You have the premium of 100,000 under IFRS 4. You've got the claims of 20,000, commission 20,000, management fee 25,000. Then you got bonus of 5,000, and then you got profit of 30,000. What I'm saying is that this is what you see in terms of insurance reporting. Now you look in terms of Takaful reporting and look at the final column. What's the difference there? No difference. It's the same, right? So this company here, for all intents and purposes, can either be a Takaful operator, Takaful entity, or an insurance company, because the entries are the same. There will be differences when you consider, but the wakala fee basically cancels out, all right? There's no wakala fee at the Takaful entity level. Here we're not talking about card, so that one thing that we know they will have to incorporate this point in time. So what I'm trying to say, like I said just now, it can be a consolidation, or it can be seen as actually reporting as if you're an insurance company. So that's why under current, there's no argument. Auditors are happy, right? If they think it's Takaful operation or they think it's plain vanilla insurance company, under IFRS 4, you let like beauty is in the eye of the beholder. What does the beholder see? And that's what you will see. Okay. So the other thing that you have to actually ensure is that you need to preserve and not compromise the underlying economic phenomenon of Takaful, right? I mean, a profit is a profit. It should not change based on the accounting basis that you use, right? Okay, the profit could change in terms of the timing of the profit, and when it emerges, depending on how you put your accounts together. That happens in banks and all other institutions, what provisions you make, but the total profit should not change. There are issues under IFRS 17 because there are complications. Under IFRS 4, IFRS 17 requires that non-insurance component of the contract be excluded from the insurance accounting, right? So IFRS 17.12 explicitly provides for accounting of the TO as a manager and administrator. Then this should be covered under 15, not IFRS 17, right? This provision is also not in IFRS 4. Next point, while it's clear that the Takaful fund is a mutual insurer and reporting at the portfolio, i.e. you don't need to use cohort, you at the portfolio level, because it gives the same result as looking at the group level, looking at the Takaful fund contracts on the annual cohort, profitable classification. You do that calculation and do it at the portfolio level, it's the same result, right? The status of TE is uncertain, right? If TE is indeed underwriting the insurance contract, then what is it? You say it is underwriting insurance contract. What is it? Is it mutual? No. Is it a part mutual, if such a thing actually exists? Or is it a plain vanilla insurance company? you have to actually address that situation. Then there's the option of applying IFRS 10. You consolidate the Takaful operator, with the Takaful fund, the two columns, you consolidate it under IFRS 17, right? However, this requires that a 3-column approach be adopted. Currently, MSB is only saying use a 2-column approach, not 3-column approach, because of cost benefit. Right? Let's assume that you go for the 3-column approach. So this option of consolidation can be either very easy, because everybody have consolidated their subsidiaries accounts before, and their subsidiaries could include insurance companies, or very difficult. If it's difficult, it could even be impossible. Now, if the intention is to actually portray the Takaful entity as underwriting the insurance contract. And why is this? It's because of the complication that you will face. And this is something that Joanne's presentation will actually address on Friday, of applying IFRS 17 B67 to B70 at the Takaful entity level. Couple more slides, last slides, right? So the question I have a question here is that, can you actually preserve the economic phenomenon Takaful, at the Takaful entity level based on what actually been recommended by MSB? So the final slides. Moving forward, I think it's very important that the industry, Takaful industry, move away from ticking the boxes. You got IFRS 17, paragraph XX says you got to do this, tick. Paragraph says you got to do this, tick. That's not the way you should be looking at it. IFRS 17 is a principles-based standard. It's clear from the documentations that you can read on IFRS 17. There are certain concepts and principles it wants to actually achieve. All right. Okay, that is what you want to achieve in an insurance operation. What is it you want to achieve in a Takaful operation? What are the outcomes that you want to achieve? Certainly, the outcomes must be consistent with the laws of the country, like the sharing 50-50, right? Like having the profit of the participants determined by the wakalah fee that you set, right? So it cannot be just ticking the boxes. The second thing here is that you should not actually do the accounting if it results in a change in the underlying economic phenomenon. ISB is very, very clear about that. The fundamental, basically the conceptual framework for financial statements says that you must preserve. That's why it says substance over form. What's the substance of the contract? What does it actually achieve? What outcomes that it actually achieve? So based on the outcomes you want to achieve, will your accounting actually show that? It does not say this is not about timing here. Not about timing on when the profit emerges with the operator or the shareholder. It's actually about the dollars and cents in terms of total profit that emerges. Does it change or not based on the accounting that you actually want to apply? And keep in mind what example that Hassan gave. By just changing the wakalah fee for the same, i.e. if you were to actually apply accounting at the contract level, all right, you get the same profit, 200, 200, 200. Hassan's example, right? But because you have, the Takaful fund, the wakalah fee determines actually how much goes to operator of that 200 goes to operator and how much goes to participants. So it is not actually like, just putting the figures in different places. No, it has an impact in terms of exactly how the financial results of the entity will actually pan out going forward. And then finally, this final point here, who is responsible for actually ensuring that the accounts are prepared appropriately? Well, actually, it is actually the Takaful operators. They are responsible. They are responsible for presentation of the accounts. The role of the audit firms is only to confirm compliance. Now, it's principles-based, basically, right? It's principles-based. There's not one way of doing things. If the preparers comes out with a basis which confirms that, which actually results applies the principles to get the results, the audit firm will say, okay, that's one way of doing it. I don't have a problem with that. It complies. Okay, but how currently, my personal opinion is that the account preparers are not doing enough to ensure that the reporting under IFRS 17 will be true and fair, right? They do have at MTA level, they have got advisor there, but the advisor is the same advisor as advising MSB. So the issue of looking at it from a different perspective. Has the Takaful operator actually done that? Look at the other options it has in terms of actually doing the applying IFRS 17, to the company. Because ultimately, and this is very serious, the management is responsible for ensuring that the operation is Sharia compliant, and that includes that the Sharia, the Takaful entity financial statements are Sharia compliant. Okay, that's it. I've run out of time. I think there's no time for questions. Over to you, Joanne.
Thank you, Zainal, for giving us such an insightful discussion on the application of IFRS 17 on Takaful. We can have a look at Slidos for the questions that came up from the participants. Okay, first one. Is it common that reporting is different for solvency and financial reporting? In Malaysia, there's only one. So I think under IFRS 4, I think in Malaysia, currently for solvency and accounting for financial statement, we are using the same computation for our reserving requirement. So I believe that some of the countries, accounting reporting and solvency reporting, or even tax reporting are using a different calculations. So I think that's how the question.
Yeah, Joanne, yeah. I think you can simply look at Europe. Europe basically applies Solvency 2. But UK has got its own GAAP, UK GAAP, in doing its accounting. So it doesn't have to be the same. It's just that for Malaysia, we have one basis for determining the technical liabilities, and it applies basically to for the purpose of solvency. It applies for the purpose of financial reporting. It also applies for the purpose of tax, right? But in some countries, you've got different bases for accounting, different bases for solvency, and even different bases for tax. Is that Malaysia? We've got one.
Okay. Next question. In Takaful, the position of the participants may be so vulnerable. Applying IFRS 17 is one way to protect the participants. If not applying IFRS 17, then what?
Well, I think this in a way is why you have the Takaful operating framework. So there's the thing about monitoring and applying. So in terms of application, you've got a TOF that is there to protect the participants, and you've got Bank Negara as well, looking at the company to make sure that pricing is done properly, wakala fee is okay, So IFRS 17, the accounting is effectively the monitoring part of it, but there's superficial monitoring in a way, because you do the accounts only once a year, and it's public, and things can change very fast, as it were. So I think it is one way of monitoring it, but there is a limit in terms of what you can actually show in one piece of paper, income and outgo.
Yeah, I think based on current proposed MESP columnar approach, I think it's moving in the right direction, that we are showing the Takaful fund and Takaful entity on a separate column. So the participants can actually see the position of the Takaful fund.
Yeah.
Hence, they can assess whether their benefit is protected in some way.
Yeah.
I think we are moving in the same direction, is in the correct direction, I believe.
Yeah, I agree with that. Yeah. It's good, which means that it's important that IFRS 17 accounts, does give that information to the participants. So we just having one column, which was what was proposed before, and putting everything in the notes will not work, because, to be honest, nobody reads the notes. Okay.
Yeah. Next question. What happened to surplus under IFRS 17 with CSM in the picture? Single CSM or two CSM?
This is an interesting question. When we started looking at IFRS 17, we said there should be two CSM, one at the operator level, one at the Takaful entity level, and one at the Takaful fund level. Then subsequently, we moved to perhaps one CSM. That would be perhaps at the Takaful fund level. It can also be at the Takaful entity level, you might argue. But now I think, it could be no CSM. How does that work? Well, we can discuss that, in the final presentation after Joanne's. So the CSM thing is a sticky point because you note, when I did the presentation just now in terms of IFRS 17, you see the CSM coming out at the Takaful entity level. All right, so that's how basically MSB is looking at it, one CSM. But that assumes that the Takaful entity is reporting based on IFRS 17. What if, and we're not quite sure yet whether that is practical or not. But if the Takaful entity, because the Takaful entity, you cannot, are you an operator? Are you an underwriter? You cannot be both, right? So if you're an operator, there's no CSM. If you're an underwriter, there is CSM, right? So this issue about CSM, I've gone from 2 to 1 to perhaps now 0, but I don't know. It needs to be actually analyzed further. Yeah, go on.
Yeah. I think similar question is on the third question. Sylvia, would you be able to pull out if the third question, if accounting risk fund as a mutual, is annual cohorting requirements still applicable?
No, I mentioned this. No. You can go back to TRG September 2018. There's a paper, TRG, ISB TRG here, and then there's an example there which shows, that if it's a pure mutual, then effectively you don't require annual cohorting. Annual cohorting is required for all entities, all insurance entities, all insurance contracts. But if you can prove that at the Takaful entity, if you do it at a portfolio level, it gives the same result as at the group level, then you can just do without it. And the crucial part of actually getting that conclusion is that the distribution of surplus to the operator is part of the fulfillment cash flow, right? It is not a residual, if you like. It's a part of fulfillment cash flow, and therefore there's no residual, in the Takaful fund. And because there's no residual in the Takaful fund, everything is distributed. Then effectively, to the, through the various fulfillment cash flow, then effectively you don't need annual cohorting.
Yeah. Another similar question on annual cohort is on the third question. The lowest level of grouping under IFRS 17 will be annual cohort or onerous, non-onerous remaining grouping.
No, it's this is the thing. At the beginning, I mentioned that you really need to really understand IFRS 17. Maybe this was typed in while I was doing my presenting, but effectively it goes back to what I mentioned just now. We will be at the portfolio level, PRF. There's no need, if you were to follow through the mutual concept, there's no need to actually separate between onerous, non-onerous, and remaining, because the BC70 to B70 is applied. So if there is you don't have onerous, non-onerous contract. You have onerous, non-onerous PRF, all right? So you have a Takaful operator, you can have multiple risk fund, right? And one risk fund could have a card. So there's an onerous risk fund, okay? Because you cannot use the profit from the other risk fund, if you like, to subsidize this risk fund. But then again, if you expect that card to be repaid in the future of the same risk fund, then it's not onerous to the parties, or not onerous to the Takaful entity. Because effectively, what the Takaful entity does is give us a loan, and that Takaful fund, which is so-called onerous at that point of time, will effectively prepay the card in the future. And one thing as well, you have to remember that this onerous, non-onerous normally is labeled when the policy starts, when new business is written, if you like. So okay, just to finalize, just basically to just the final statement of that one, you don't need, for the Takaful fund level, you don't need that. Now, Takaful entity level is different. Now, Takaful entity level, you have to apply the cohorting. You have to apply the onerous, non-onerous. All right. The question is, how do you apply it? That is the million-dollar question.
Yes.
If you don't do the consolidation thing, but you apply it on a standalone basis, that's the difficult part.
Okay, agree. Next question from Arif. Assalamualaikum, Encik Zainal. With the IFRS 17 reporting, does Mudarabah model have good potential for Takaful operator compared to Wakalah model?
The Mudarabah model, in a way, is a dinosaur. I think, see, you are a Takaful entity. You usually choose a model which is most beneficial to you. Although the Mudarabah model is very good at resolving the Takaful conundrum. You remember the Takaful conundrum? You have got the operator as a driver, and the participants are passengers. The driver takes you wherever he wants to take you with it. By the Mudarabah, basically the operator, the driver, is very cognizant of the fact that if the participants is not happy, he won't get anything, he won't get a tip, right? So there's actually, the two sort of interests are actually together. So from the perspective of fairness, you want to talk about fairness, in terms of protecting the policyholder, then the Mudarabah model is great. And IFRS 17, you can apply IFRS 17 the Mudarabah model, but what happens is that you got zero, you have zero wakalah fee. All right. In fact, this is something that needs to be considered very carefully. Whether those on the Mudarabah model, from the operator's perspective, it's all onerous. We just consider it like there's a zero wakalah fee. It's all, and here for sure, because zero wakalah fee and all your profits, if you like, comes from the underwriting surplus, then what MSB says in regards to the fact that because most of the profit comes from, all the profits here comes from the Mudarabah, from the profit share, then what was mentioned before does not apply, because IFRS 15, you got no income here. All right, there's no income. The only income you have is a contingent income. So that's interesting. How do you actually apply? What does Mudarabah model implies for the purpose of reporting at the Takaful entity level? So what's exciting about this is the fact that you really need to understand the principles under IFRS 17 if you want to apply it to Takaful. What is the outcome that you want to achieve? Is it? But ticking the boxes will not work. You need to really understand the model, what is the results, and then you might try and see whether in fact you can fit it. You can fit IFRS 17 into your accounting model. Okay, next one.
Okay, next question. Don't you think if there exists few options in preparing account, the purpose of IFRS 17 cannot be achieved in terms of comparing account between company? This is quite interesting. I think IFRS 17 is a principle-based standard. So the standard doesn't really tell you what to do. It just says that as long as you can show the correct result at the end, you can use whatever method that you want. So I believe there's probably no company that will choose exactly the same option on applying all the different methodologies. So
yeah, well, this one, Joanne, one thing as well we have to also keep in mind is that it has to be Sharia compliant. So in addition to satisfying IFRS 17, you have to also make sure the Sharia is happy with the way in which the accounts are prepared. And that part of it is whether that result in convergence in the way of how you apply IFRS 17. We have to see whether that does actually happen. But I'm not sure in the first place whether we have few options. I did not say there were few options. All I said was effectively that you should not actually just tick the boxes when you apply IFRS 17 to Takaful. I didn't say there are many ways of doing it. I say there's a principles you have to actually apply. The question is that what does applying the principles result in many different ways of presenting the accounts? Maybe, all right. If that's the case, and that actually happens, then how do you make it comparable across different companies? Which is a valid question, because when the purpose of 17 is to make sure the accounts are comparable. In this case, the Takaful accounts are comparable. So we have to see, because I think from the perspective of Malaysia or countrywide, of course, the regulator have got a big say in this, and of course, the accounting standards board in a particular country will have a big say in this now, effectively in terms of what is acceptable and what's not acceptable. Hopefully, even though there could be some options, the differences are not so significant. So comparability is not. But one thing as well, if I just find out on this question, one thing as well, you see, in terms of the Takaful entity level, the issue there is actually profits to shareholders, right? So I would say that the profits to shareholders are driven by the Takaful model, driven by the Wakala fee, all right? So if you have got application of 17 that recognizes all these basic sort of issues, then you should result in the same profit. It's just the timing. So maybe a few options, but the total profit should not be different, right? How you recognize the profit every year might differ based on the options that you apply in your accounting. But remember just now I said that the economic phenomenon should not change because of the way in which you account. Economic phenomenon should be the same. The profit to shareholders ultimately should be the same. It's just a question of when does the profit emerges to the shareholders.
Yeah, agree. Next one, similar question. Can you elaborate further? What do you mean by financial statement has to be Sharia compliant as well? Does it mean Sharia compliance is at stake using IFRS 17?
Sharia compliant here is this one word, no risk transfer. All right. So at the TE level, you have risk transfer, it's not Sharia compliant. Okay. So does it mean Sharia compliance is at stake using IFRS 17? No. IFRS 17 can be applied such that it can be Sharia compliant. I mean, IFRS 4 shows that, because but you see that IFRS 4 was if you like, was not a difficult decision to make because, as I said before, it is in the eyes of the beholder. In the eyes of the Sharia is the risk sharing because it's consolidation of the operator column and the Takaful fund column. So it's risk sharing. But in the eyes of somebody else, forget about the first two columns. Look at the last column. It's risk transfer because the entries are the same, is it? All right. So ideally, that's what you want. You satisfy everybody, but I don't think that can be achieved. So the acid test is that is at the Takaful entity reporting level. Is it risk transfer or is it risk sharing? If it's risk transfer, you have a problem with Sharia. If it's risk sharing, everything is fine for Sharia. You can do whatever you want, it's okay. Right? So this is important from the perspective of communication as well. I hope that's clear.
Yeah, I think that's one of the reasons why I think the discussion on IFRS 17 on Takaful in Malaysia has been going on for so many months, because I think we also need to take into account the opinion from Sharia Council of the insurance of Takaful operators to see whether they are okay with that type of presentation as well. So for insurance company, I think it's clear IFRS 17 you can apply straight away on what is in the standard. But for Takaful company, they should discuss with their Sharia committee on proposed presentation of IFRS 17 on Takaful business, so that they can actually voice out whether the proposed approach is okay or not.
Yeah, I think when you present, and one thing you have to when you're an actuary or you're the management, if you like, when you present to Sharia, you need to also bring out, what are the issues that people are actually discussing in regards to, this issue, this particular question, because I think we have to also accept that not many Sharia scholars are actually knowledgeable in terms of 17, because Sharia compliance can be very wide, I mean, for example, I'll give a simple example, Muslims cannot eat pork, all right? Sharia says it's not Sharia compliant. But if you're on a desert island and the only thing you can eat is pork, it's Sharia compliant. You can do it. So if we say that, okay, Takaful entity, IFRS 17, we have to, Bank Negara says we have to apply IFRS, all right? It means we have to apply IFRS 17. It means Takaful entity column must be IFRS compliant. Auditors say the only way it can be IFRS 17 compliant if it's treated as basically like a insurance company, then you have to eat pork. Because you have got no option, is it? It's still Sharia compliant, So the issue now is that basically, you need to. I think one of the things that we have to accept is that we do want to be as a country we want to follow IFRS because it gives the country a certain level of stature that people, when they come and invest in Malaysia, this country follows IFRS standards, so I can trust the accounts that's being presented. So we have to, if at all possible, we want to say that IFRS applies to Takaful. One point here, which you can also try and consider, is to look at what I mentioned, the conceptual framework for financial accounting, right? The conceptual framework for financial accounting, I referred to the 2010 version, but there's a 2018 version which becomes effective from 1st of January 2020, right, for preparers, right? And this conceptual framework is there for preparers to actually use when they're not clear in terms of what the standard actually, how to apply a particular standard, or, and this is a very big or if they say that there's no IFRS standards out there at this point of time that could apply to this particular accounting. So if you say that effectively Takaful accounting, IFRS 17 does not actually cannot actually be applied, you can still be IFRS compliant if you actually apply the principles and concept expounded under the conceptual framework for financial accounting, and you can still sign off to say that the accounts are IFRS compliant. However, and this is very important, that conceptual framework does not override any existing IFRS standards. It does not override IFRS 17, right? What it does allow you to do is actually maybe extend IFRS 17 a bit, right? That bit, of course, needs to be agreed upon so that you can apply it in Takaful, right? So on that basis, you're not ticking the boxes. You need to look at it. You need to look at it carefully and you need to see what outcome you want to achieve and how you can achieve the outcome by actually maybe tweaking IFRS 17 a bit. But I'm treading on very on thin ice here because I don't want to say that you can do that. It's something to consider.
Okay. Next question, similar topic. Will there be a unified approach to IFRS 17 from Takaful operators? Otherwise, there will be differing interpretations, and will it still be comparable?
I think we discussed this before, right? I think the good thing about Malaysia is that now we tend to move in total together. So I suspect that ultimately there will be a standard which everybody agrees. It's just that there could be variations because of the Takaful operating model that the company actually uses. So I think the word is that the interpretation will have to be the same, where it's principles based. You cannot, well, maybe not. You have principles based, you can interpret it differently, isn't it? But it's something that we have to actually consider going forward to see whether they can unify and remove the too much inconsistency in terms of reporting for company A and company B, because we want it to be comparable.
Yeah. Next question. Why surplus to be distributed is not considered as a non-distinct investment component? Is it mainly because it needs to be shown in the income statement?
Okay, yeah, go on, Sonjan. Who you want
to? Just trying to define what is investment component.
Yes, please. Yeah.
Not familiar with investment component. So this is actually defined in the IFRS 17 standard, whereby it says that this is the minimum amount that the entity will give back to the participants, whether or not an insured event happen or not. For example, this policy coverage cover death benefit. So if the policyholder do not claim any death benefit, and should surplus and they will continuously receive surplus distribution year on year. So should this surplus be considered as investment component?
Yeah. Okay. First of all, going back to IFRS 17 concept, IFRS 17 concepts takes the current insurance premium, all right, and then takes out from that premium, part of the premium which does not relate to insurance contract. So what's insurance contract? Insurance contract is about underwriting. You actually underwrite a risk. It's not about savings. It's about underwriting. Right? Savings is investment, not underwriting. right? So what we have got here is that, a non-distinct investment component is non-distinct. But first of all, it's not. First of all, you have to ask now, is basically surplus distributed an investment component? Like what basically the as defined by Joanne just now. Investment component, you get it back regardless of whether you claim or not, right? The second portion is non-distinct. Non-distinct means it's not as clear as it could be when you have, savings which is totally separate component of the premium, which is totally separate, nothing to do with the insurance component. So we're not talking about that. We're talking about it being an investment component. It's a non-distinct investment component. It's a subset, if you like, investment component. Darrell Scott had an interesting sort of explanation. Darrell Scott is one of the board members of ISB. Gave a very interesting explanation in terms of what actually constitutes an investment component. And what he first of all, he says that, when you say you return the money back to whom? Is it the policyholder or a policyholder? There's a difference between the two. All right. Now, if it's the policyholder, then effectively, the policyholder that pays the premium basically will receive the surplus, if you like. When you say an policyholder, it could be that the policyholder that pays the premium, which has the surplus, does not get that back. Somebody else gets it, right? So the issue here is that for Takaful, which is it? I mean, first of all, is it an investment component? Well, he goes to this explanation. What happens on the winding up? If on the winding up, basically, any surplus left in the pool after winding up goes to a policyholder, then it is an investment component. Because remember just now, it does, for investment component, this description to actually be satisfied, it does not have the surplus or does not have to go back to the policyholder that contributes to the surplus. It can go to, policyholder 50 years down the road. It's still treated as investment component because it goes back to the policyholder. So if you look at the power fund, for example, power fund, you have the power fund at the end, winding up, if there's surplus, it is distributed, right? And a policyholder does get the surplus. But in Takaful, under our act, on winding up, if there's surplus, it does not go to the participants. It's very clear on that one, because remember, what the Takaful pays into the PRF, the risk pool, is actually a donation. What's the definition of donation? A donation is paying somebody, it's a unilateral contract. You pay somebody a donation, you don't expect, the next day to say, oh, have you spent all the money? Is there anything left? Can I have it back, please? No. Right? So in the case of Takaful, if there's a surplus in the risk pool on winding up, the money does not go back to the participants' pool. It might go to another risk pool, all right? It might go to the PIDM. You know what PIDM in Malaysia is? PIDM basically is an institution that insures all the insurance funds and all the banks in Malaysia up to a certain level. So you might even go to PIDM. So because of that, because it does not go back to a participant, it is not an investment component. And as it's not investment component, it can be accounted for under the income statement. Right? So it's not because of the fact that you have to show it in income statement, otherwise the participant will be upset. That's not the reason why you have to show it. It's because of the fact that that surplus did not necessarily come back, will not effectively come back to a participant. And that's how Takaful is managed. It's a donation. The surplus can go anywhere. Like Hassan said in his presentation, the surplus distribution doesn't have to be fair, right? So people. I find that frustratingly, people try to actually relate Takaful PRF to a power fund. It is not. A power fund basically has got an investment component. PRF does not have an investment component. The investment component is basically in the PIA, right? Power fund have got, you have to ensure you are fair policyholder on the generational basis, but PRF, no, you don't have to. It's up to you. This question.
Okay. Next one, shall Wakala model of Takaful be using IFRS 15 instead? So I believe here refer to the operators fund.
Yeah. Yeah, for sure. So you've got three columns basically. You got operator fund, you got the risk fund, and the Takaful entity. No, everybody is agreeable that if we have a Takaful operator column, that it should be accounted for under IFRS 15, right? It's just that the MASB is saying that from the cost and benefit perspective, you don't need to show the Takaful operator column. You just need to show the Takaful fund column and then the Takaful entity column, right? But then the question will then arise: should you apply IFRS 15 to the Takaful entity column? Because I as mentioned just now, you are either an underwriter or you're a manager. What are you at the Takaful entity column? Underwriter or manager? If you're an underwriter, then you apply IFRS 17. If you're a manager, you apply IFRS 15. That question is a tough question. The easy way around it is to say that you have the operator, one entity, IFRS 15, Takaful fund, one entity, IFRS 17, and Takaful entity, consolidation of the two. But basically make sure that, at Takaful entity level, you don't show a risk transfer. Don't go to the dark side. You are actually a Takaful operator, sort of you believe in Sharia compliant of insurance business. Don't go to the dark side. Okay.
Okay. Before I forget, I just want to remind everyone that we are going to have a panel discussion on Friday after our last webinar series on Friday. So the Q&A session, hopefully, the panel session, hopefully will start about 12 o'clock. So during that time, all the presenters from the 5 Takaful webinar series will be online. So we will be able to answer the question that you may have. So it's not necessarily restricted to the Friday session. You can ask questions related to any of the Takaful series that we have been presenting. So started from last Monday until this coming Friday. So if you have any further questions, so you can also join our Friday session to pose the question to the presenter that you wanted to ask. Okay, we will send the details on that shortly. Now we quickly finish off the remaining 2 questions. Next one, even if we could justify Takaful not to use IFRS 17, would it help Takaful to gain more investment to grow using IFRS 17?
I think this goes back to what people expect from the accounts. As I mentioned before, I mean, the chairman of the working group ISB sort of lamented the fact that the current IFRS 4 is not sufficient for accounting because of the fact that people tend to revert go and use embedded value valuation and the likes, if you like, to look at whether a business is profitable or not. So by using IFRS 17, then investors looking at the accounts, so let's see. In fact, under IFRS 17, maybe for the first time, maybe you can actually look at the PE ratio of insurance company and compare it with other PE ratios in other countries, because the earnings part, if you like, the earnings part, if you like, is effectively consistently calculated regardless where you are. Okay, so we're not saying here that don't apply IFRS 17. I've already in my presentation I've said that you apply IFRS 17 for sure. At Takaful fund level, it is IFRS 17. All right. So and also I said at the beginning of the presentation, I said that IFRS 17, you should not think of IFRS 17 and say, oh, IFRS 17, it must be applied to the whole entity. No, IFRS 17 is about insurance contract accounting. So in Takaful, the insurance contract, all right, resides in the Takaful fund. So IFRS 17 applies to the Takaful fund. We don't disagree with that. IFRS 17 applies to the Takaful fund. The issue is now at the Takaful entity level, right? How do you apply IFRS 17 at the Takaful entity level? Do you treat it, Takaful entity, as insurance company, risk transfer? In which case, yeah, you just apply IFRS 17 based on risk transfer. Or do you consolidate the Takaful operator fund and the Takaful fund and come up with the final column, right? But here, the issue here will still be at the corporate entity level. Is it a manager or is it basically an underwriter? And you might argue that no, it is a manager at the Takaful entity level, if that is what the full entity column is supposed to reflect. Is it? So we have that issue that we still need to resolve. Yeah, so watch this space. Okay, next one.
Last question. Do you think it's necessary to have all the required disclosure based on columnar presentation?
Well, this is it. What makes Takaful unique? I think I showed in one of the slides. I showed that, look, we have this one column presentation, and I put at the top that company, and that company could be a Takaful company or could be an insurance company, because the entries are the same. Because there's no card, there's no wakala fee. In that particular case, everything is the same. So in order to ensure that people can differentiate, between Takaful and insurance, you need the columnar presentation, because the user of the accounts is not just the shareholders. The user of the accounts are also effectively, the participants. They look at the accounts as well in order for them to determine, whether they want to buy policy for this particular company. So columnar disclosures is necessary. And also, don't forget as well, there is a legal requirement, not legal requirement, the act, if you like, does say that the Takaful fund is a separate entity from the Takaful operator, right? And if we don't show that columnar approach, that important fact will be lost. And I think, one of the issues about accounts is always been the case of how much information you show in terms of the accounts itself and in terms of what is actually in the disclosures, in the statements, if you like. So you do need that columnar approach in order to differentiate Takaful from insurance. And that's important as well from the Sharia perspective, because a Sharia scholar looking and seeing only one column will for sure say it's not Sharia compliant, because it does not show the independence of the Takaful fund from the perspective of how profits and losses are determined on the underwriting side. Okay.
Yeah. Okay.
Done, kan?
Yes. Okay. So thank you very much, Izzat Zainal, and thank you ASM, and thank you Silva for arranging all this webinar for us. And thank you all the participants as well. Hopefully you learned something today. Okay, so our next Takaful webinar will be on this Friday, 11 o'clock. You'll still be able to sign up. And as I mentioned before, we're going to open up we're going to have all the presenters for the past Takaful series to be online. So you can ask any question you want, and we can try to answer those questions during that session. Okay, thank you everyone.
Thank you everybody.